Have you ever felt the bitter sting of disappointment after missing out on an IPO allotment? Welcome to the world of retail investing, where allotments can seem like a game of chance. A recent study by Edelweiss Research brings the harsh reality to light, revealing that retail investors secure allotments in only about 10% of IPOs. Moreover, the average allotment size has been shrinking, leaving many investors with only a handful of shares. Consider the allure of the initial public offering, the promise of growth, the potential for profit. Yet for many retail investors, the reality is a far cry from the dream. Despite having the capital, the will, and the belief in a company's potential, they often find themselves left out in the cold, their applications for shares either rejected or drastically reduced. The recent IPOs of Zomato and Nykaa have once again brought these challenges to the forefront. Take Zomato's IPO in 2021, for instance. The food delivery giant's entrance onto the stock market stage was met with enthusiasm from retail investors, their dreams filled with visions of substantial returns. Yet the reality was a stark contrast. Many found themselves holding only a fraction of the shares they had applied for, while others were left empty-handed. The story was no different with Nykaa, the online beauty retailer. Despite its impressive growth trajectory and strong brand presence, retail investors again found themselves on the sidelines, securing only a small portion of the shares they had eagerly applied for. High expectations were met with disappointment, as dreams of a windfall turned into a tale of missed opportunities. This grim narrative of Zomato and Nykaa echoes the experiences of retail investors across numerous IPOs. These are not isolated cases, but a systemic pattern that leaves retail investors on the losing end. A few key factors contribute to this recurrent issue. First off, let's talk about oversubscription. It's when there's a far greater demand for shares than what the company can offer. This often puts retail investors at a disadvantage because priority is usually given to institutional investors who have deeper pockets. The second hurdle is the minimum lot size requirement. This mandates that investors apply for a certain number of shares, which can be a significant investment. This requirement can be a tall order for many retail investors who may not have the capital to invest in such a large number of shares. Lastly, the allotment process itself can be quite opaque. It's often shrouded in secrecy and influenced by broker discretion, which generally favors institutional investors. This lack of transparency breeds frustration and a sense of unfairness among retail investors. These factors combined make securing an IPO allotment a daunting task for retail investors. The impact of these challenges extends beyond individual investors. When retail investors, who make up a considerable portion of the investment community, are consistently shut out from participating in IPOs, the consequences are far-reaching. Not only does it stifle their financial growth, but it also perpetuates wealth inequality. The current system, which often favors institutional investors with deeper pockets, creates a barrier that prevents retail investors from accessing potentially lucrative investment opportunities. This lack of access to IPOs hampers the ability of retail investors to diversify their portfolios and partake in the success of burgeoning companies. In conclusion, there's a pressing need for a more transparent and equitable IPO allotment process, a system that levels the playing field and provides retail investors with the same opportunities as their institutional counterparts. It's high time the system changes to give retail investors a fair chance at accessing promising investment opportunities.